Good morning. This is Ken at Tortoise Capital with a review of the weekend trading report for May 4th, 2019. So we have a market that is in bullish normal conditions, favors the long side. We are significantly overbought on both an annual and a 10-day basis. So we're going to make sure we lock in any gains, but we will be open to the possibility of a new leg starting uh, given the political climate. There may be some opportunities for more gains, plus really strong news on the economy on Friday that could provide a burst. In the market mosaic, slope with respect to the 50-day moving average is yellow neutral, so still trying to find its legs for this next run. ADX is a strongly trending 32.7 for the bull. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. It reads at 1.009, so we're just still into risk on. That has a z-score of minus 0.01 compared to the 5,000-day look-back period. So you can see a 90-day histogram of that indicator here. We've had a really nice swing bull run here. Steady, stable support, dipped briefly into risk off. There was a nice second leg up, and we are just on the boundary right now of being in the red. So we are at a critical state, and we will be ready for larger than normal moves in either direction in shorter than normal periods of time. So this favors the short-term trader who can combine intraday turbo with swing core positions to get the most out of this market and to provide some hedging against some adverse moves. The blended monthly rebalancing holdings you see for the month of June, and then a slate edit based on the prices on Friday. So U.S. large caps have nudged into the top, although real estate still has been strong. So theoretical exposure in ETF2 remains at 90%. Take a quick look at some ETF2 portfolios. Here's the ETF 13. Everything on a buy signal except the weak areas in Latin America. U.S. real estate, as you can see, has been very good. ETF 32, again, mostly on buy signals. Energy, gold, Latin America, Brazil, and agriculture are the only weak areas on cash. Meanwhile, technology, consumer discretionary continuing to lead the way. I consider the industrials position here to be a very strong signal for ongoing strength. If you just look at U.S. steel's performance on Friday, that could be a turning point in the industrials. Among the sectors, the same information: technology, home builders, consumer discretionary, and again, once more, industrials and real estate. Only the energy sector really showing weakness. ETF Max, the strength continues to be strong in semis, technology, China, clean energy. So we'll be looking for some more momentum there. The ETF2 regional report, 9 out of the 10 sectors are on buy signals, so that keeps us at 90 and 10 in the theoretical model. Bullish normal, the U.S. at 57 is better than the globals at 51, so it's the U.S. And then within the U.S., it's tech, large caps, mid caps, small caps. Two strongest sectors, U.S. tech and large caps, I would say, although EPP has started to make a move. And then the two weakest, Japan and Latin America. Inside the sector spiders, it's consumer discretionary and technology clearly in the lead, and energy lagging. In the world market model, again, U.S. is all above average, technology especially so, Hong Kong and most of the rest of Asia looking strong as well. Brazil and Latin America really suffering. Canada with its commodity-based index still looking pretty good though. U.S. real estate and private equity doing fine. Gold and silver temporarily lagging. Shifting to the daily. In the market health check, so we've had a nice recovery move here from 280 all the way up to 294. It's at all-time highs up here around 295, and there was a two-day pullback, but a strong vote of confidence based on the employment report on Friday, which gave us some very nice turbo moves intraday. So in MACD histogram, we're in the fall, and this is right at a kind of key turning point here, that if we get some more follow through, this will become the next leg up of summer. Otherwise, it fails back towards the zero line, and then we would expect starting the test of these different price levels on the price ladder on the way down. But I'm ready to add strength to this market, add money to this market on signs of strength. The last time we had that little pullback, it voted up, and it voted up. So third time pays for all. Let's see what we get here. Looking at the daily, no signals and channeling and overreaction. You can see the usual suspects here among the 10-day max pains. 3M continuing to suffer. I think that's a buy on dip opportunity. Intel shows some potential buying quality on sale. Disney remains a must-own and is on sale. Just a couple channelings, channeling and overreaction here in oil in the ETFs, and only a few firing on the auto framer. That's oil exploration and energy, and then oil itself. Nothing on the RSI2, and only a couple frog quality numbers. So energy is looking like the potential move here, and you can see that the UDOW really made a nice move on Friday as well. Strength in small caps with breakouts to previous time period highs, also in Asia, less Japan, and in the global. So there is some broad buying interest around the world, and I will be watching IWM for trader indications on Monday. In the Dow, a few more signals on channeling overreaction. Plenty to choose from on the auto framer, a couple 551Ws here, and Cisco and Boeing that are of interest. Some good frog quality numbers inside here. And Cisco, with a 4 on the RSI2, shows some potential for a one-day pop as well. In the daily pinch and stretch report, just a couple super pinches. Disney, Morgan, Financials, American Express, all looking like potentials for follow-through. Microsoft has just been quietly getting it done. Seen already 3M and Intel as negative Z stretches, and that's probably an overreaction. Anytime I see it more than one sigma, that's usually an opportunity to start framing a rebound. The most expanded pinch boxes, these are the ones where the trend has been the strongest. We're approaching critical states in these where they continue the momentum that made the river so wide, or we get a reversal back to the Bollinger Band mean, and that means there's plenty of distance for that to go. In the auto framer, a lot to choose from here. I mean, 3M at 12 to 1 based on 10-day highs. Intel 6 to 1. ExxonMobil 6 to 1 also. So lots of very good low-risk trade frames for one-day pops and for swing trades. The Four Seasons, again, this is the kind of pattern that I like to look for. This turned out to be a really nice move in Verizon, but I like to see those pullbacks. Finding support has been put in place. The winter has given yield to spring, and then there's a move back, and then some universal entries when it crosses the dragon have led to some very low-risk moves. So I would be looking out of the spring candidates, IBM, Chevron, United Health, Merck, and Pfizer. And then the deep sell-offs, these are the ones that are in winter. So 3M, ExxonMobil, and Intel, and Verizon still continue to be those deep sell-offs. Nice, strong, quiet move here in the S&P. That tiny little dip, but showed strong recovery potential on Friday. We're testing the limits of the stretch, however, so that makes us at a critical state. But again, the slope of the 30 is all looking favorable. This means there's still plenty of room to go, that there was a bottom put in, but it's not excessively steep yet. And Mochi, the Wonder Dog, agrees with me on this one. Thanks, Moach. You can see we're pushing all-time highs here and riding the upper limit of the edge of the river. And that's everything I want to cover for this weekend. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.